everything is getting more expensive. Rent, food, gas. But why? Let's talk about inflation and how it affects your wallets. In this video, we'll cover what inflation is, why it happens, future inflation trends, and if we can fight it back. Let's dive in. So what exactly is inflation? Simply put, it refers to the decrease of the purchasing power of your currency. For instance, 20 years ago, a gallon of milk cost under $3, but today is over $4. A dozen eggs, once priced at $1, now cost around $4. The average cost of the house in the US has surged from $200,000 to $500,000 in the same period. This doesn't mean these items have just become more expensive. Rather, it indicates that the value of your money has diminished. The price change can vary for different items, which is why governments use a measure called Customer Price Index, or CPI for short. The CPI tracks changes in the average prices of a set of consumer goods and services, like food, housing, transportation, and healthcare. Over the past 20 years, the cumulative inflation rate, or CPI, has increased by 66% in the US, meaning an item that cost $100 20 years ago now costs $166. Is inflation only a problem in the US? Hell no, it is a global problem. For example, in Poland, where I live, in the last 20 years, cumulative CPI reached 91%. That means if an item costs 100 zloty in 2024, today you pay for it 191, which is almost twice as much. Many other countries around the world experience inflation at similar levels, or in extreme situations, even a hyperinflation. Hyperinflation is when prices rise so quickly that money becomes almost worthless. Imagine you go to the store today and bread costs $1. By tomorrow, the same bread could cost $10. In a week, prices go up to $100, and it keeps happening faster and faster. This is hyperinflation. Now, don't get me wrong. Hyperinflation is an extreme event, usually triggered by extreme situations like war, revolution, or total collapse of the economy. While I do not foresee a hyperinflation happening in any of the major economies, like the US, Eurozone, or Poland anytime soon, it is important to remember that it has happened in the past, so we cannot rule out this happening in the future. Most famous example of hyperinflation is Germany in 1920s, following World War I, when the price of bread skyrocketed from quarter marks to 200 billion marks in just a few years. Most recent example is Venezuela, where in 2018 inflation reached over 1 million %. With such inflation levels, everyday items like food, medicine, and gas become nearly impossible to afford for ordinary people. Poland, while not experiencing hyperinflation on that scale, also faced significant inflation at the end of 1980s and beginning of 1990s during the collapse of communism, with inflation reaching about 600. Okay, but let's come back to modern day inflation in developed countries. Why is this happening? First of all, there might be temporary events in the world which cause spikes in inflation. For example, oil supply shock, new tariffs, or supply chain interruptions. And this is logical. For example, OPEC countries might decide to extract less oil in the coming months. Less oil on the market results in higher gas prices. Higher gas prices lead to increased transportation and manufacturing costs. Fun fact, oil isn't just a fuel. It is key raw material in production of plastic, synthetic materials, chemicals, and many other products. Okay, but does it mean you should start now obsessively tracking global news, trying to predict which event might affect prices at your local store? I wouldn't go so far. The most attention-grabbing headlines are designed to stir emotion, especially fear, rather than to provide a balanced perspective. Instead, I focus on the big picture. And to truly understand inflation, we need to examine the most important factor of all, the monetary policy. Most national currencies have their own central bank, which dictates that policy. For example, in the US, it is Federal Reserve. In the Eurozone, it is the European Central Bank. In Poland, it is the National Bank of Poland. The main objective of central banks is to keep inflation under control. But what does it really mean under control? By the inflation number I showed at the beginning, we clearly see they don't do a good job, right? Well, most economists around the world agree on theory that the small inflation around 2% per year is beneficial for the economy. This is because it encourages spending and investment, which makes sense, as if prices are expected to rise slightly over time, people and businesses are more likely to spend and invest, which stimulates economic growth. Inflation also prevents deflation, which are falling prices. At first, falling prices sound good, but it might reduce customer spending. People delay purchases, expecting lower prices. This slows down the economy, reduces wages, and increases unemployment. That's why central banks and governments around the world are so much afraid of deflation and would do whatever it takes to avoid this. Additionally, inflation helps to manage debt. With moderate inflation, the real value of debt decreases over time, making it easier for businesses and governments to repay loans. Fun fact is, the biggest borrowers around the world are governments. Now that we know that the inflation helps to repay loans, we can be pretty sure governments don't want inflation to go away. With all that said, central banks set inflation targets. For example, Fed seeks to achieve annual inflation rate of 2% over the longer run. EBC also targets 2% annually. On the other hand, the National Bank of Poland targets inflation rate of 2.5%. What tools do central banks have to manipulate inflation? Most important tool is setting interest rates. Interest rates affect the cost of borrowing money by businesses, government, and individuals. For example, if inflation is too high, central bank would increase interest rate, which would in turn increase the cost of borrowing money. Meaning less money being borrowed, this limits economic activity and money supply. On the other hand, if the inflation is too low, central bank would cut interest rates, which makes borrowing money cheaper. More money being borrowed results in more money in circulation and increased economic activity, which leads to inflation getting higher. In extreme situations when the central bank is afraid of deep recession, the central bank might go a step further and print money. Meaning, the central bank would not only allow governments, businesses, and individuals to borrow money cheaply, it would additionally create new money to pump them into financial markets and the economy. All of this to increase economic activity. This would exactly happen during COVID, when Fed not only cut interest rates to almost zero, drastically reducing cost of borrowing money, but also printed tons of money. On this chart we see the total money supply in the United States. Since February 2020, money supply increased from $15,000 billion to $18,000 billion in just 4 months. Then, in April 2022, the total money supply in the US reached almost $22,000 billion. This is 40% increase of all of the money in the US in just over 2 years. According to basic economic principles, when the supply of a good increases significantly, its value declines. Given this, it's no wonder the US dollar lost 8% of its purchasing power in 2022 alone. Fed was not alone. Other central banks around the world followed similar policy of cutting interest rate and printing money. This resulted in higher inflation almost everywhere. Does it mean all of the new $7,000 billion were simply printed by the Fed? Not exactly. Most of the new money supply in the modern world is actually created by the commercial banks. Yes, you heard me right. Commercial banks can create the new money. This happens through fractional reserve banking, where banks issue loans that effectively create new money. When a bank gives out a loan, it does not take that money from existing deposit. Instead, it creates new money electronically by crediting the borrower's account. This increases the broad money supply. In step-by-step example, let's imagine. Emily deposits $1,000 in Bank A. At this point of time, Bank A holds $1,000 in deposits and $1,000 in reserves. However, Fractional reserve banking allows banks to keep only 10% of its assets in the reserve. In our example, Bank A is mandated to keep at least $100 of reserves, meaning it can lend out the rest 900 to, for example, John. John now takes this 900 and buys a lab. Now, the 900 which shops has earned is deposited into Bank B, which now has 900 in deposits and reserves. But again, Bank B keeps 10% as reserves, which is $90, and lends out the remaining $110, which ultimately will be deposited into another bank. This process repeats, with each new bank keeping 10% in reserves and lending the rest. What is the final effect? There is more money in circulation. The original deposit was only $1,000, but the total money in circulation increases due to repeated lending. Based on money supply reserve multiplier, we can see that initial 1,000 deposit can generate up to 10,000 in the economy through repeated lending. Due to fractional reserve banking system, the total money supply is growing all of the time, with the process accelerating dramatically during the COVID period. The most important lesson here, inflation isn't a coincidence. Inflation is a built-in feature of the system. Now you might say, okay Piotr, 2% of annual inflation isn't that bad, right? And I would agree with you. In the short term, this is not a big deal. Let's assume you have some savings you need to use in the next year or two. Perhaps it is not a bad idea to keep them in the savings account or even in the cash. It is definitely better than investing in a risky asset, especially if you don't have much experience with investing. However, even annual inflation rate at 2% is devastating in the long term. Let me show you how. Let's assume you have $100 and keep it in cash. After 1 year, this money will be worth $98. After 5 years, with annual inflation 2%, this money will be worth $90. After 20 years, it drops to only $67. After 35 years, you are left with money worth only $50, a half what it used to be. This was ideal scenario when the central bank always delivers on the inflation target. But history teaches us it is not always the case. Let's assume now a bit worse scenario with 4% annual inflation rate. After first year, your 100 will be worth 96. After 5 years, 82. After 20 years, it drops to only 46. And after 35 years, you are left with money worth only $25. That's bad, don't you think so? Okay, so what are my inflation predictions and what we can do about them? First of all, I'm not an economist, nor do I have a crystal ball. Therefore, I cannot predict what inflation will be. In fact, it is very hard to predict inflation, especially in the long term. However, I can tell you what are inflation expectations of respective central banks or analytics agencies. National Bank of Poland expects CPI in Poland at rates 5.6 in 2025, 2.7 in 2026. TradingEconomics.com expect inflation in the US to be between 2.4 and 2.9% in 2025. By this expectation, we see both Poland and the US are still higher than the target. Can you protect money from inflation? Absolutely. There are several ways to do it, from simple bank deposits, which unfortunately often lag behind inflation, to other investment options like bonds, stocks, real estate, or even a Bitcoin. If you want to learn more about these investment opportunities, especially how to invest in them in Poland, be sure to subscribe to this channel. In the next episodes, I will be covering them in details and providing step-by-step tutorials how to get started. Thanks for watching. I'm Piotr from MyInvest and I see you in the next one.